Welcome back. You're with us on Trading Hour. We have Maneesh Dangi from Mosaic Asset Management joining us on the show right now for some perspective. Manish, always great to have you on. Pleasure. So even the market has had to digest a lot. The fact that elections are finally over and the fact that the rate cut expectations, I guess, both in US and in India, they're getting pushed back. But equity markets don't seem to be complaining at all. So what do you make of things as they stand right now?
So equities dial, of course, is that the margins sort of stay super high, both in US and India. The profit margin in US are sort of near all-time high, at least 20-year highs, 13% or so, if you look at MSCI universe. Something similar, you could say, it's like a post-2007-8, we haven't had this sort of margin. So, I mean, equities dial is largely about margins. I know, as a matter of fact, everywhere the rate cuts have been pushed out, but I don't think sort of bond market watchers sort of think of terminal rates at any different level than what they were thinking even 3-6 months ago. The transition from relatively buoyant economy to rather slower in US is there, but it's sort of relatively slower than what many people anticipated.
Okay, so it's been slower than what was anticipated. Maneesh, good morning. I was just reading one of your write-ups. It's been a while. You wrote it around 5 months back, which said most overrated story in India is the India routine consumption story. I wanted to understand what are your thoughts on that right now, because everyone's talking about consumption coming back, be it in the rural areas, or maybe some push towards more spending and more consumption. Do you think still the long-term story remains overrated?
So sort of I'll try and link it with political outcome. So there aren't too many obvious learnings or messages from the political outcome in India. But if there is one, and that is that, there is some distress in below median population. And if we were to amend that, and this government has been sort of pretty deft at it, I'm assuming that incremental actions would be taken to heal that part. And which is why actually, if I were to sort of take off a cyclical view, which is like next 1.5 year, I would not be surprised if the bottom of the pyramid, or I won't say bottom, the median person's consumption, would actually get a little bit of a perk up. So there are two parts to the point that I would have written. The structural story of India, that India is a great consumption story. Once you contextualize to the rest of the world, it isn't sort of any significant. It's just that the cyclical part of it, that we've had a pretty depressed consumption over the last 2 years. I think, that should begin to revive. Especially rural folks, would see sort of more sort of wallet share being spent on, or rather bigger wallet as well as more wallet share being spent on consumables, particularly staples.
Maneesh, so what should the portfolio strategy be going forward? And I also wanted to get your view on the way bonds are behaving in trading, because we're finally getting close to this all-important global bond index inclusion, right? India making the cut. And we've already seen that rally play out. So on bonds, is there more left to play? Or do you think the best of it is probably in the price at just under 7%? And on equities, I mean, what are the kind of returns you'd expect for the rest of this year, given the fact that we are, already at all-time highs?
So there is sort of clearly a case of Achhe Din as far as bonds are concerned, and perhaps it's sort of a secularly good run. Bond market participants have had sort of a very bad 15 years, that the booms were short and persistent bearish markets sort of, which led to the situation that income funds, gilt funds, long bond guys never made big money. I guess, we are given demographics, given the fiscal orthodoxy, and now that we have an assurance of similar policies over the next 5 years from Modi government, it's likely that we would enter in longish bull market as far as bonds are concerned. So almost everything is coming alive, both on the macro side as well as demand supply. So one, of course, is this 28th of, a lot of money starting to come in. But I kind of think, that for the foreigners, India's story is actually a bond story, given that they are out there struggling for many other things, not just the transient inflation that they have right now, but potentially high fiscal deficit and such like. I guess India offers a great opportunity, a mid-yield opportunity for a foreign investor. So I think the drought in Indian bond in terms of flows will end. You will have many, many billions of dollars sort of starting to come in India, already which has started. And I think I've made this point to you folks many times that I won't be surprised in this cycle, bonds head to near 5%, and which is sort of very, very significant. And once I tie this to asset allocation, given that, as you said, equities are very pricey, you have an earning yield of just about 4.5% in India, very depressed. I don't think people should expect any significant risk premium as far as equities are concerned. So a better place to hide incrementally, of course, is bonds, not equity in India.
And this is a time when we're talking about equity markets doing really well and bonds as well, seeing a lot of flows, the JP Morgan bond inclusion and the other aspects of the bond market as well. Maneesh, I wanted to understand your outlook on metals. Our colleague was just telling us that copper is off those 2-month lows. It seems like now it has bottomed out in terms of prices as well. Will we continue to see an uptick in metal prices? And is this something which is a structural story, considering that we hear a lot about capex, not only domestically, but globally as well?
Yeah, so it's less of global and more of China. I think, how dislocated the whole macro dial has become and how divergent each economy is sort of advancing. You had sort of severe Europe recession or slowdown, so to say, 1.5 years ago, and US continued to do really well. China, surprisingly, had a very, very depressed outcome post-COVID. But what is likely is that while US heads to sort of severe slowdown, if not recession, China actually is prepping itself up for a potential stimulus. And the growth is sort of reviving there, fairly decently. And that is what the metals are proxy for, I guess. I kind of think that oil will tell you a story of global growth, but more specifically incremental growth coming from US, whereas copper tells you a story of, it's an insider of China. And it's telling you that oil is relatively getting better as far as China is concerned. So, apart from the general stories like EV consumption and all the new age businesses, which consume a lot of metals, I guess that as a macro, China would potentially do much better. And that means that, you'll have two divergent trends, at least until it's very evident that US is in deep recession, that metals would do better versus oil.
Okay, so money is to be made in the bond market, maybe not the equity market for the rest of this year. I'm going to remember that one. Let's see how it plays out. Great perspective as always. Thank you very much for joining in, Maneesh. You have a good rest of the day. Well, with that, we'll take another quick break, come back on the other side, and we'll get you more on the markets.